Good afternoon. What's up, everybody? This is Anthony D'Ambrosio from Supply Chain Solutions, and you are listening to the Ship Show Series podcast. Today's Thursday, September 27th, 2023, and this is episode number 36 on our series this year. And it's that time again, folks. It's all about the FMR, the freight market roundup. There's a lot going on right now, potential government shutdown looming. We're going into Golden Week over in China. So there's a lot to cover, and I want to introduce my amazing partner, our Director of Client Development and Outreach, Jason Brand. Jason, what's happening? How are you?
I am good, Anthony. How you doing?
I'm good.
Oh man, yeah, you hit the nail on the head. I mean, I love to quick tell this story, but we started this show during the peak of the pandemic disruptions, and it was a broadcast to our clients to basically say all the stuff going on, everything we were doing, and how, quick strategies to kind of mitigate some of the issues. And I got to be honest, I mean, we haven't had a calm week since, and that's been a few years now. So
absolutely.
I can't wait to say things are smooth sailing. It is a good week this week, people. But no, we got a little bit of whiplash still we're dealing with, so we'll dive into it. But hey, if you're returning and you've been watching our show, thank you so much. Tell your friends as well. Obviously, we want to spread the word about this. We do what we do because of you guys, so really we appreciate it. And if you're a new viewer, thank you so much for joining us. I hope we can kind of enlighten your week and help you out with some of your decision making for, obviously next week, but also beyond. We cover a lot in this show. So to give a quick overview of who we are, Anthony and I, represent SCS, or Supply Chain Solutions. And really, it's our goal, and we've done this over 20 years, to become a one-stop shop for all of your logistics needs. So that starts with shipping to and from more than 160 different countries, but also we've got an expansive multi-continental warehouse network that is consistently growing. Right now, we're actually growing it as well. And we also have sourcing solutions and a suite of technologies that just make it easy to ship. And they also help you sit at the table when making business decisions and factoring in things like the market trends and also, hey, am I doing the right thing right now? So we're really excited about all of our new technologies we've been bringing together and also creating this integrated technology platform. And that actually reminds me, we have a fun show next week. We'll get into that more later, but just about really the new age of technology. Anyways, so for today, we are going over the freight market roundup. Now, obviously, if you are used to our show, you understand what that entitles. But just to make sure everybody understands, we do have a little agenda we like to follow here. And it just makes it a little more digestible. Because we don't have visual aids, it's easier to follow along. So first, we're going to go through our major ocean shipping lanes. We're going to start with the Trans-Pacific. Then we're going to move over to the Transatlantic. Then we're going to end the ocean shipping portion by talking about our China to Europe shipping lane going through the Suez. Between each of these sections, we're going to cover some current events. And those events really are things that our teams are really focused on, things that are going to move and shake as far as in the shipping industry. So stuff you got to watch out for, or things our clients have said, hey, can you talk about this week? I'm curious about that. Really cool stuff. Some of the weeks, it's hard to get through everything. This may be one of those weeks, but we do have a lot of ground to cover. So we're going to dive on in. And yeah, let's get started. Trans-Pacific. So this, remember, it's going to be our Southeast Asia, and that's going to be heading over to the U.S. West Coast. Now, quick reminder, when we go through this section, we're not talking about the full shipment. We're talking about the ocean portion of the shipment. So you're going to want to look at your invoice, and you're going to want to identify the ocean shipping cost. And if you can't see that, that's definitely a red flag. You need to either take control of your shipping because you're likely paying too much, especially right now, or B, you got to find a better provider. Little tidbit for our contractual customers, we have a way of operating that we love, and we'll actually just have a management fee, which is totally transparent, and you'll actually see what we're paying for the freight. So it's a great way to keep you completely in tune with the market and make sure you are paying what you should. So keep that in mind. But that reminder, remember, we're just talking about the ocean portion. So over the weeks, we've talked about this lane a lot. It's really been propped up recently by a lot of these capacity levers that are getting moved around. That includes price controls like general rate increases or GRIs, And then most recently, it's been this peak season surcharge, or PSS, which a lot of those have just been ending recently. But there is an undeniable fact here on this lane and why the rate has been doing what it's been doing. And that's just that there's not enough volume in the lane at the moment. Now, on our last freight market roundup, our ocean rates were hovering at around $2,070, and that was per 40-foot equivalent unit, so FEU. And this was just an average for our customers, and this average is compiled the week before. So when we look at this week, right now, we're seeing a drop of roughly $300, $200, $200 to $300. We're sitting here in the 1,800 range. And this is obviously compiled as of last week. This is a huge drop, especially on a lane that's been, kind of hovering near the floor for a while. And I did kind of give a little sneak peek as to partially why some of those peak season surcharges were due to expire earlier in the week. So that has actually had an effect on rate averages, but still, this is very cheap for this lane. Anthony, before I dive into some things, you want to mention anything?
Yeah, just real quick. So just to elevate a little bit more about what you said, those Trans-Pacific rates really rebounded only slightly after that September 1st general rate increase. And I really think that, the carriers, we're seeing a trend now where they started to offer, rate discounts and remove the peak season surcharges before the Golden Week holidays, and starting on October 1st through the 9th or 10th, I believe that is. So, as Jason said, there's not volume, there's not a lot of demand. So, as the demand starts to normalize, the freight rates are falling, have been falling through the rest of September. Mm-hmm. And, they're going to fall further as we move into the fall. And I think, those rates into the U.S. East Coast and the Pacific Northwest have really started to slip due to that excess supply on those two routes, while the Pacific Southwest are a little bit more stable as the demand and supply on the route is a little bit more balanced. And I think the other, let's just say the fly in the ointment here are the new ship deliveries that are coming into the rotation. And so carriers are cutting rates through September, and it's both affecting Asia-Europe rates as well as Asia to U.S. rates. And the outlook is really turning increasingly negative with the pressure from the supply side. So though the rates, like I said, though the rates rebounded slightly in other trade lanes through September, I really think that, as we move into the fall, we're going to see the rates continue to fall a little bit more. And then we'll start to see it pick back up again as we start to move into Chinese New Year, into the new year. So, it's a real mixed bag. And, I just, as the end of this third quarter approaches, there is really a buildup to a relatively, what we'll like to say, a modest peak season, in the fourth quarter this year compared to last year. And I think a lot of that has been mainly driven by e-commerce products demand, for the upcoming holiday season, especially out of China. And especially as Jason was talking about this, we talked a little bit about this last week when we had, our people from SCS Dallas, our new G4 acquisition in. We talked a little bit about the China market and about the new technology rollouts with Apple and so forth. So, that's my spin on the Asia part, Jay. Back to you.
I think we were pretty spot on with this one with these predictions. So when we saw there wasn't a bump up prior to Golden Week, that pretty much spelled, I'm not going to use the word disaster, but pretty much spelled flat remainder of the year. And the carriers, so right now what we're seeing is the week after Golden Week, we're looking at like roughly October 9th through 15th. Carriers have announced what is considered a record. It's a new record high of capacity cuts. They are blanking sailings like you wouldn't believe. So they're trying to obviously manage this lack of demand. And if you kind of look at some of the lanes, the Asia to Europe lane is going to have 41% of its available capacity blanked. And then also we have 50% of the Asia to North American West Coast blanked that week as well. So we are definitely seeing the carriers pull all the levers they can. And,
Yeah.
unfortunately,
Go ahead, Jay. Go ahead. No, unfortunately, go ahead, Jay.
So unfortunately, when we had all those ship deliveries and all those ships being purchased during the pandemic, the timing of their completion is it's a killer right now. So
I was just going to just augment that a little bit more and piggyback on what you were saying about the vessels, because when you think about it, folks, when we look at the data, January through July of 2023 saw deliveries of new vessels with a capacity of 1.2 million TEU, which stands for 20-foot equipment unit, 20-foot containers entering the global fleet. And so think about it. Since January of 2023 up until July, 1.2 million 20-foot containers came into the global fleet with less than 80,000 TEU capacity removal through vessel scrapping. And another 1.2 million TEU are expected to be added by the end of the year. So to put it in perspective, just think of this. The previous single year record for annual growth was 1.7 million TEU, and that was back in 2015. So, overall, the vessel capacity continues to trend higher than the demand, and that's really keeping the rates from long lasting or significant increases. So it's just something that we're really going to have to keep watching, as Jason is always telling us.
Anthony, that hits hard. That hits very hard. And, as like a little silver lining to that, I do expect we've got all this regulation coming up when it comes to carbon initiatives, and it actually technically began at the beginning of this year. We had a show covering it, but the enforcement starts January 1st of 2024, and we'll touch on that a little bit going forward. But I do feel like Anthony mentioned it, how much capacity was scrapped. I do feel like that is going to be the moment when carriers really decide, hey, which vessels of ours are not reporting well and are going to cost us too much to ship. And there's going to be a little bit of a pruning that should happen. Only negative is, with these carriers who were making just money hand over foot during the pandemic, now they're all having these, double, triple digit, 6, 7, 8 digit losses. So it's it's a very unique time to make these predictions. But want to dive into a little piece of information that popped up just this week, actually, and it's not a fun fact. So truckload thefts, they are actually increasing. And so just as of this week, it was reported that thefts rose from 454 in the second quarter of 2022 to 582 during the same period of this year. Pretty big increase over a 1 year. And the value of stolen goods has surged substantially higher. It's up $44 million more worth of goods were getting stolen this year than last year. And this is particularly in the food and beverage sector, but also in the electronics sector. And now you may think this can't happen to you, but you may be surprised the areas which are the hotspots. So one, Los Angeles, which would be expected. Actually, that ties into the electronics components. Also, we've got Houston, but we have Chicago as well. And these were the most targeted areas. And the two most targeted good types were energy drinks and solar panels. The solar panels were in Los Angeles mainly, just because there's a lot of green initiatives going on, and that is kind of feeding into that. Now, these cases are also getting substantially harder to solve because the thefts are getting a little bit more complicated. So there's a great new example of a theft type that's exploding right now. And it's been drivers faking that they're drivers. They're using fake IDs. And there was only 2 instances of this that were caught and reported back in the second quarter of 2021. In 2022, that number grew to 9 instances in that second quarter. And then this year in the second quarter, it went from 2 to 9 to 127 instances. So definitely skyrocketing there. And remember, these are only the instances where it was caught. So keep that in mind.
And Jay, real quick, just on that point about the theft. So folks, remember, it's not just in the United States, it's all over the world. So the Supply Chain Solutions New Jersey operation is heavily involved in cosmetic logistics. We like to tell people it's more than just moving freight to point, especially when you're moving high value cosmetics. There's a real methodology to it. So we handle a lot of foreign to foreign shipments, like, for example, coming out of Italy or Germany or Spain going into, say, England. Okay. We literally last month had one of our drivers going from Italy to UK by truck held up at gunpoint. Okay. And they took all the cosmetics amongst other cargo in the truck. So it's really getting crazy out there. It could happen anywhere, and you could take all the precautions, but when you're held up at gunpoint, there's no stopping that. So,
Mm-hmm.
you know, just you made me think of that, and I thought it would be a neat story to tell.
Oh yeah, no, that was fantastic. Actually, it's funny because now I don't have the data to support this, but when I was doing my reading on this, there was a little statement that said years when inflation is highest, generally you see cargo theft increase as well.
Yeah.
And, you know, we had Dave Griffith on last week, and we were talking about Mexico, and obviously Mexico has issues with cargo theft. And, you know, there's a lot of different methods that we use in Mexico that they use that we're now adopting to, you know, be able to support lanes that are a little bit more risky. But what is interesting is if that statement was true on the years that inflation go up, you also see cargo theft go up. It is tricky, right? Because some of these areas that aren't as used to having to deal with that are now obviously more vulnerable because they don't have the same precautions set up. So it's definitely something that, you know, obviously with our acquisition, we're more focused on. And, you know, seeing this news, it's something that our team is thinking about and how we are going to make sure we're not caught in that situation going forward. It's the ever-changing world of logistics. You got to love it. So love it. And when I say love it, obviously we're coming off cargo theft. So you know what I mean? So
absolutely.
Let's dive into this. The UAW strikes. So they are still in full effect, and we've had a couple individuals throw their hat in the ring. So Biden did announce his decision to go to Michigan and join the strikes in Detroit. And this happened just a couple hours after Fain said the union would expand their strike to include Stellantis and GM. So it's 38 locations across 28 states. And then following that visit, also, we've got former President Trump, who also did visit this Wednesday in Michigan as well. Now, Biden went on to say that he does support the workers' negotiations, and he also said he does support the 40% pay increase in the 32-hour work weeks that they're asking for. So, you know, Anthony and I have watched a series of union negotiations over the past year and a half. And, you know, we have also seen the government getting more and more involved in the whole yellow situation. I think it's, you know, the government got involved. They were also one of the main creditors, though. So that's a little bit blurry. You can't really include that as much. The rail situation, we've got a lot of history with rail problems. So the government, you know, as we expect, did get involved. I'm curious to know the involvement here with the UAW, if it's just political theater or if we'll actually see some results in the next couple of weeks. Anthony, what do you think about that?
Yeah, you know, I am hoping there's going to be results because, you know, as you know, Jason, and many of our partners know, you know, Supply Chain Solutions is heavily involved in the automotive industry. And what we're hearing from our clients right now is, you know, they're okay with inventory for now. But if this strike goes on another 45 days, like say it goes 45 days more, it's going to be a real fly in the ointment. It's going to be a problem. Some of the stuff I think is political theater. You know, and of course, you know, at the ship, you know, show, we don't like to get into the political end of it, but I do think there's some theater in that. But I'm really, really concerned for all those American jobs and, you know, our great companies in Detroit and in Michigan, in the great state of Michigan. I hope these guys just get it together, because when you think about it, if you just look at the news and look at the big picture, you know, you've got ILWU and ILA on strike. You've got the Actors Writers Guild on strike. You've got, you know, the auto workers on strike. I heard about another strike this morning. I can't think of it right now. There's another group of people that are, everybody's striking. Yeah. So it's like, it's just some phenomenon right now, I'll tell you.
It really is. I think that these contracts just had a perfect storm with the inflation years. And then we also have, the just major economic changes that the pandemic has forced us into. It's really creating a tough environment, and both sides are in a tough position, right? They've been stagnant for too long, and then employers have been having a very challenging series of years. And so they don't have the money to pay more, but the wages are too low. And so it's just I'm glad I don't have to be negotiating that one. Let's put it that way. It seems impossible. So let's move it on. There is a ton here that we got to cover, so we're going to keep going. So transatlantic. Our transatlantic lanes, we're talking about Europe coming into the US, specifically into the East Coast. So on the previous shows, we have watched most of our global shipping lanes see a boost in cost from these GRIs and the PSS and all these blank sailing capacity levers. And, in the past, months now, the East Coast has just been, unfortunately, not enjoying any stability. Despite all of the attempts from the carriers to kind of try to keep prices from falling, it's been falling regardless. Let's put it that way. But this week, we actually have seen a slight change. We've seen a little bit of a price floor. So remember, the way we do this, our price averages are as of last week. So last week's price averages compared to our last freight market roundup, which technically here 3 weeks back. So 3 weeks back, we were coming in at around 1370 a TEU. And, I hate to say it, unfortunately, I was hoping it'd be more stable, but we're all the way down to 1100 a TEU right now. And excuse me, these are not TEUs. These are all in FEUs, 40-foot equivalent units. And Anthony, how cheap is it to ship a FEU for $1,100?
It's cheap.
That's unbelievable. I mean,
it's real cheap.
Yeah.
And I'll tell you a real quick story. I was talking to our executive vice president of international solutions, Dennis Rolls, about a month ago when we were really looking at some of these rates. And, Dennis has been in the business for 53 years. And after the U.S. Came off the gold standard in 1972, and then they had the first OPEC, essentially, the oil crisis for the very, very first time. Ocean freight rates actually went into negative territory because as we see the rates keep falling, especially if you think about going into the West Coast, you know what I mean? Mm-hmm. You start to think, wow, will we have a negative rate structure at some point? It sounds far-fetched, but it's not really that far-fetched. People would just pay a booking fee, so that's really cheap. And, I got to tell you, when you think about it, Jason's talking about East Coast right now. Correct me if I'm wrong, Jay, but when you think about all the volatility throughout the summer with the U.S. West Coast ILWU negotiations and the West Coast ports and the Pacific Maritime Association, ocean carriers really shifted vessel capacity from the U.S. West Coast to the U.S. East Coast ports, not only just because of the congestion that took place in 2022, but it also was coupled this year with concerns about, the negotiations. Okay. And, some things I was looking at, I really don't think that, the analysts are monitoring this, but we don't think to the extent that vessel capacity is going to return to the U.S. West Coast ports the way it used to be. I think permanently that the U.S. East Coast is going to be the beneficiary of additional volumes because the ILA union is a little bit more stable than the ILWU. And I just think, we're not going to see, I don't know if it's ever going to return to the way it was on the West Coast. It'll be busy, but they won't have a monopoly on it. Before, people never really wanted to come into the East Coast unless they had to,
Yep. I agree.
That's just my spin.
No, that's a great spin. And quite frankly, with all of the improvements that the East Coast specifically have been doing, there's a whole cold chain new situation that was built. I mean, seriously, the East Coast needed to catch up, and they had the years during the pandemic, and they used that money very wisely. A lot of the ports in the East Coast have seen major projects, really expanding what they're capable of, dredging projects to allow larger ships to come in. I mean, it's a whole different world out there post-pandemic, which is great, except we're not having the demand we need to support that new infrastructure right now. But this is just, it's a small blip in time. We have to get through this whiplash period. There's a few just macroeconomic things that have occurred because of the pandemic, and we're still working those out. So as soon as we're able to kind of normalize, those ports will definitely get more utilization. And, and as you see automation start to spread throughout, some of the costs might be mitigated of, even shipping, from China to the East Coast instead of going to West Coast. You still in the future may be seeing these costs be relatively comparable depending on where your inland point is that you're shipping to. So, it is a really, we're in some struggle years, but we're going to see some really fantastic years after this because we have truly set up a great infrastructure that we desperately needed to invest in. So it is little silver lining to that. And I totally agree with you, Anthony.
Absolutely. I totally agree.
So let's dive back into it. A couple things. Very cheap right now. Not as cheap as what Anthony was talking about, but very cheap as far as, recent history goes. And this is transatlantic going into the East Coast. Now, as I kind of teased at earlier, we were talking about this before. We had an episode focusing on the new carbon initiatives that were coming into effect that start at the beginning of next year. So January 1st, 2024. And really, it is a great time to go back, find that episode, watch that episode. It's got there's just a lot of details you've got to understand about it. But, what's going on currently in relation to that is these new decarbonization costs. They are bumping up the agenda for European shippers to get into their contract talks a little bit early because they're looking ahead at their next year's shipping budgets, and they've got to include these new green surcharges that were decreed by the IMO last year. So this new system, this new carbon kind of control system has gone under a lot of names. One that seems to be floating to the surface is called the European Union Emissions Trading System. You might see that a little bit more, but as we get into next year, you'll see which one of the acronyms kind of prevails so you understand which initiative we are addressing. But ETS for short for now. But the ETS, it's essentially a carbon tax, and all ship operators are going to be required to monitor and also report their emissions. And then they're going to have to surrender allowances for every ton of CO2 they emit, covering all voyages within the European Economic Area, and 50% of voyages that are ending or beginning in European ports. So, fuel consumption and CO2 production, they're obviously, depending on which type of fuel you're using, there are some differences here. But just to give you an idea of typical large container ship fuel consumption, generally speaking, we're looking at around 5,000 gallons of fuel every hour. And that equates to roughly 6.5 tons of fuel every hour. Ballpark, it's hard to give numbers to this because each of the ships really can vary substantially, and also depending on how fast they're going, that's a huge influencer as well. But the fees that are going to have to be paid are on a escalating structure. So shippers are going to be required to pay for allowances covering 40% of the fees for the greenhouse gas emissions in 2024. That's going to rise to 70% in 2025, and then all the way up to 100% in 2026 and beyond. So, it's going to be, the numbers that it's going to cost per container are a little rough right now. We saw all the way up from 5, and it's all obviously in pounds and in euros, but we've seen everything from 5 pounds going up to 70 pounds, but more than likely we'll see those numbers kind of start to meet a little bit in the middle. So we really are expecting 30 to 50. And obviously with the escalation, you really have to expect on the higher end of things, especially as we're looking into 2025, 2026 and beyond. So keep that in mind. That is a big change coming up. Anthony, before I dive into China going to Europe, do you want to mention anything on that?
No, Jay, I think you covered it all. We should dive right into China.
Let's dive right in. So our last freight market roundup, you may remember us talking about how this lane was a big mover back in August. And we did see this lane at the absolute lowest cost of all the major shipping lanes in the ocean world at the time. So rates were coming in at $1,000. And that being said, that was $1,000 per TEU. Now we are talking about FUs, 40-foot equivalent units. And this is truly just because, we enhanced the way we can break down our data. And also some of our clients were like, I don't ship with 20-foot units. Can you tell me about 40 foots? So we had the ability to do that. And so we're doing that now. Now, there was a lot of things that kind of influenced the lane recently. A lot of the levers that influenced the other lanes, the GRIs, the peak season surcharges. And we saw that $1,000 per, remember, TEU go up to $1,800 per TEU, given capacity cuts and these new charges. Now, considering that, and considering both of those were in 20-foot equivalent units, not the 40 foots, what we're seeing now is at a 40-foot equivalent unit price. 3 weeks ago, we were at $1,200. That was our last freight market roundup. This week, we're at $1,080. So technically speaking, this is the lowest this lane has been all year, because last time it was at $1,000, it was in a 20-foot equivalent unit. So something to keep in mind, this is unbelievably cheap. It's also, we've called it this before, it's the barometer of ocean shipping. It's a good barometer for demand. The China to Europe lane, generally speaking, is China to Europe. Finished products happen in Europe when they ship into the US. So you see the lack of demand there. It really can trickle down. So, it's just a pretty interesting situation. Now, Anthony, you want to mention anything on this before I dive into some stuff going on in China?
Just that, you've hit on all the right levers. It's just, there's that continual conversation in the background about further blank sailings and capacity withdrawals. And, I read something this morning where we've gotten some confirmations, that the Ocean Alliance and 2M are both going to be cutting capacity because the overall situation remains really unstable and demand's not picking up and sailings are not going out 100% full. So again, we're just going to have to keep watching everything and keep our fingers on the pulse of everything that's going on in the ebb and flow of the market right now.
Anthony, I'm about to blow your mind. You're not going to like what I'm going to say about China right now. Are you ready?
Good.
Okay, some hot off the press news. Hot off the press, let me tell you. So major developments in the Evergrande situation. Now, Evergrande, if you don't know, is the largest developer in the world. They have a ton of assets. Issues with Evergrande can definitely cause a domino effect. So you don't like to see issues with Evergrande, even though there's been a lot of red flags happening lately. Let's put it that way. So as of today, Evergrande asked for a suspension of trading of their shares. And this didn't only include their property services group. This also included their new energy vehicle group. Now, we talked about this a couple of weeks back with Orient Star. Their new energy vehicle group was really the bright spot in a very murky situation they were in. Trading being halted on both, not so good. Couple hours after that announcement, the Evergrande Group said their chairman and founder, and I'm not even going to say his name because I'm going to slaughter it and it's going to be embarrassing, but placed under a so-called mandatory measures due to illegal crimes. And that's not all. Turns out over the course of the past month, the executive group has been all slowly arrested and detained. It's not announced exactly why, but the founder now under this mandatory measures is kind of painting a pretty ugly picture. So one of the things you have to remember is right now, Evergrande is still the world's most indebted developer. They've got roughly $327 billion in liabilities. And it sparked a huge crisis in China's property market when it defaulted on offshore debt 2 years ago. Now, the concerns surrounding the company, they've been really intensified lately. And this is because smaller developers have been having defaulting issues. And so that kind of makes you look up at Evergrande saying, hey, how are you doing? That's all I got for it right now, but a lot of things happening just this week on this situation. So we need to stay tuned on that.
Absolutely.
Oh, man. Let's dive into air and let's just keep this train moving. So air rates actually have shot up pretty remarkably It was given, we were expecting this given Golden Week, but still hitting high shipping rates right now is a rare thing. So we're hitting nearly a 2023 high right now at $6.45 a kilo if you're shipping out of China into the US. LAX is the least affected, which you'd expect because it's the closest destination, coming in at $5.49 a kilogram. And then JFK, which you'd also would expect would be the highest, is the highest, coming in at $7.10 a kilogram. Now, generally speaking, when Apple has a launch, you see the effect in the air rates because they soak up a lot of air. That being said, this year they made a very interesting statement that they were going to slow down and only use air when they had to and try to shift their products into ocean. And I believe, would be seeing substantially higher rates if they were shipping air. So kind of an interesting situation there. Something I'd like to dive into deeper and see really how much capacity they shifted into ocean versus air, because conventionally it was almost all air. So keep that in mind. Now, oil and gas markets, these have been interesting. So we saw a pretty much week over week increase in diesel prices for the past roughly month and a half. And that's followed almost a 5-month slow but steady decrease in prices. So all that kind of took an abrupt halt, from these increases this week. We saw prices drop just slightly, 4 cents a gallon. Now it's down to 4.58. And, that sounds good. Obviously, all of us would like to see lower fuel costs. It's just a cost a lot of us have, and it's a cost on goods. But, we also have this concept of backwardation, which we have to worry about, because this idea of backwardation, or the future value of a good being less than the current value of a good, it's a sign of a bad economic environment. So, really what you want is a slow and steady and predictable increase in costs. You don't want volatility. And so, for commodities like oil and gas, you also have to factor in things like seasonality. So, certain times of the year, you see gas prices go up versus other times of the year. That is okay to see that volatility if it's normal year over year. And just to make sure we're kind of discussing this accurately. So if we look at September 26th of 2022, diesel prices were at $4.89 a gallon. So we are still significantly lower than we were back then, but I'm going to just do something to ruin everyone's day. Back in 2019, we had in September, we were looking at prices at $3.09 a gallon. So, diesel, but keep that in mind still. But remember, don't get all hung up on 2019 numbers. We have a lot of different market factors that have been happening. So, it's not like, oh my God, look at this, it's terrible. A lot of different factors. Hey, that's what we got for you guys today. Anthony, you want to wrap it up with anything I might have missed?
Yeah, I just have one more thing. I think it's really important that we talk about it. So, as all of our listeners know, there is the pending government shutdown this Saturday. So I just think we need to talk about that for a minute, because I think we need to keep in mind and remember that, the Federal Aviation Administration, the FAA, has over 17,000 employees. Okay. And so if the government doesn't sign come to an agreement on a continuing resolution on Sunday, if Congress doesn't pass this short-term continuation of the fiscal policy for 2023, there'll be 17,000 employees furloughed. And what everyone has to keep in mind, that aviation and logistics industry officials are extremely frustrated with the lawmakers' inabilities to really fund the government beyond this Friday. And, you have to think about it. Airlines are going to continue to fly goods, and they'll be able to flow through into the land and sea ports and into the airports, because there will be frontline customs officials and TSA officials, working. Okay, they'll stay on the job without pay, but there's going to be a significant shortage of workers, especially for those support functions that are deemed non-essential. Okay, so that could, reduce the processing and efficiency and the turnaround time. It could delay not only, citizens traveling, but it's going to delay freight movements. So if this government shutdown happens, it's a real flying in the ointment, because we're going into the busiest time of the year for supply chain, when you need things to work. And yes, even though volumes are down, we're up against pretty firm deadlines with a lot of new product introductions for all of our clients from a variety of companies. And, a government shutdown would be just a catastrophe. So please stay tuned to what we're doing here at Supply Chain Solutions. Please go to our website at www.supplychainsolutions.com for the latest updates. Our amazing director of marketing, Vanessa Fry and Dax Stiegenberg, do a great job keeping everybody informed, along with Jason and I and the rest of our team. So, Jason, I apologize for going a little long, but I just thought we needed to get that out.
Yeah, honestly, it was critical, and I'm really glad you brought that up. Sometimes, we get on these rabbit holes, and I'm going to blame myself for that. So
there's no blame here.
No blame, except no. Hey, love it. Thank you all for joining us today. Really appreciate it. If you've got a topic you want to make sure we cover, or if you think we missed something, please add it in the comment section, because we'd love to touch on it in the coming weeks. Next week, we've got a guest on our show, but more on that to follow. We'll shoot out an email, and we'll throw out some marketing blasts to let everybody know who we are bringing on. But it's a big show, so get excited for that one. And yeah, Anthony, I guess make it a great day and week.
Make it a great day. And remember, SCS, global presence, local expertise.
I love it.
Have a great weekend, everybody. Take care.
See you, everyone.